But of course, we begin with the breaking news. The Dow Jones Industrial Average seeing its second 1,000-point drop as the sell-off continues. Stocks falling sharply as volatility continues to dominate the market for another day. Of course, add in concerns about rising inflation, where bond yields are going. A lot of things weighing in on the psyche of investors, all against the backdrop of an amazingly strong economy. So why are we down in the first place? And more importantly, where do we go from here? With me now, an all-star panel to help break it down, Aaron Gibbs, S&P Equity Chief Investment Officer, D.R. Barton, MoneyMorning.com Chief Technical Strategist, and John Akridge, Securities CEO. Let me start with you, Aaron. We were just talking right before the show. You wrote a letter to, is it a monthly letter or a quarterly letter?
Weekly letter to our investors, letting them know what's going on in the markets and just our views.
Did you use a lot of whiteout? Did you have to erase it? Did you start over again? I mean,
there's a lot of whiteout. There's a lot of rewriting today.
What's the gist of it? Because there's still a lot of debate on what triggered this, which in my mind makes it hard to understand how we find a bottom if we don't really know what pushed us over the cliff in the first place.
Yeah, today is interesting is that once again we're seeing this huge sell-off. We know that we're going through this reevaluation period. It's pretty much the same story that we saw at the beginning of last week. There wasn't really any new big catalyst for the sell-off today. Again, you've got to reevaluate what are you willing to pay for equities given there are some really good starting to.
But are you making different assumptions because the economy today, we saw jobless claims at a 45-year low. Corporate earnings, by the way, which have been completely, nullified in the last 2 weeks, continue to be extraordinarily strong, along with strong guidance. So what do investors base this on? Do you make adjustments with your macro outlook for the economy overall?
Not so much for the economy, but we are looking.
Like, is there a negative wealth effect going on right now that could change all your work?
I mean, we're still only down, what, 3% for the year. I mean, that people aren't going to be able to notice that on your statement. That it's basically going to just look like your December statement at this point. So I think it's not so much a wealth effect. I think for now, investors just need to remain calm. Absolutely, this is not the time to get out of the market. You don't want to be the seller in the middle of a flash crash.
Right.
And for us, things are starting to look attractive. We're slowly getting to more reasonable valuations.
You know, DR, not panicking has, I will say this much, coming into the last couple of sessions, investors weren't panicking, at least the ones that I talked to, the ones who subscribe to my services. But the last 48 hours, they're getting more concerned. And, of course, we know fear can create additional fear. Is that part of the process, though? Do investors who are standing right now pretty firm, do they have to ultimately, a lot of them, be spooked out of this market for it to find a bottom?
Well, I think that kind of capitulation is most likely needed. I thought we might have gotten it on Tuesday, Charles, when we had that 1,600 Dow point drop in 40 minutes that afternoon. But I think, the big thing on that fear is, like, we've been walking through the plains of Kansas and we've hit a little teeny hill and we think it's horrible only because, things have been so smooth and easy getting here. I think there's one really big thing that a lot of folks are missing right here, Charles, if I can chime in and get your take on this. We've heard interest rates and the bond rates are going higher, and that's what is spooking people, or macroeconomics. I think both of those can be quickly discounted. If interest rates were the problem, banks would not have been, the financials would not have been the big down mover today, right. And utilities wouldn't have been just kind of calm.
Right.
I think what we're having here may be a classic mini bubble in volatility. All these volatility instruments have really just blown up, especially the inverse volatility instruments. There's been a short volatility trade for about a year. I think that unwind is what's taken us on this quick down move, and I believe that's about over. So I'm getting kind of optimistic right here.
Yeah, and to your point, it may be a while before we complete the postmortem on just how those instruments impacted the market. But it does recall, John, 2007, 2008, when we started hearing about these other complex instruments in the real estate market and the mortgage markets that most people had never heard of, but then all of a sudden the value of their homes was half. I mean, we're not talking about anything like that, are we?
No, and that's a great point, Charles. You know, back then, remember, too, the backdrop was very different. I mean, the world was really basically going into a big downturn, and I think that most market participants would agree that that's not where we are today. I think people believe that looking forward 6, 12, 18 months out, things still look pretty rosy. And if you look at where valuations are and where they were maybe a little stretched, and now they're more rational. So I completely agree with both of you other panelists that this is a volatility, potentially extra levered ETF sell-off that's happened, correction, and that things should stabilize from here on out.
So then let me ask you, John, then why, 2 weeks ago we heard the dollar was too weak and maybe Mnuchin shouldn't have made the comments he made. Then the last 2 days it was about the 10-year yield, which really hasn't done a lot since then. And today it was about VIX and volatility. One of the issues I do have is that every day it's a different culprit. You know, are we adding more hysteria to this as we grapple for answers in public? And people are watching, you know, financial media and scratching their heads because every time they turn on TV, there's another reason du jour.
Which is a great point, which probably tells you that nobody's really right or nobody's really wrong. At the end of the day, this market has not had a decent correction in well over a year. And so that really is the reality, I believe, is that, you know, the market, I think, hasn't even been down 5% at all at any point last year. Yes, we're down 10%, but we're also up, as Melanie said, up 7.5% going into late January. So we're really only down 3% for the year. I think coolness is the right call here. I think if you are an investor in this market, I'd be nibbling at these valuations and not rushing into it.
No, Aaron, John talked about 2007, 2008, when the world went into this tailspin economically. Right now, the world has a wind to its back. And it feels like we are actually going to take another leg up with respect to our economy, particularly with all the stimulus coming in. But can we be victims of our own success? Is there a point where things can get too good, and would that actually justify the market being lower?
No, no. I mean, things can definitely run hot, and then we have to worry about rising rates and, again, revaluation. But I think this is more, we don't have to go so far back as 2008. You look at 2015, we had a flash crash. We saw the VIX spike up even higher levels than what we saw, and things weren't nearly as good as...
though.
Yeah. Well, it was a couple weeks. And the entire year, the market was pretty volatile. Okay. It actually ended up pretty much flat for the year with a lot of choppiness. That was a year where we actually had contracting earnings, and the market still ended up flat by the end of the year. So I think we don't have to worry about just a complete doomsday. We can have some volatility, we can have some down days, we can have a reevaluation, and we can end up with an up market by the end of the year.
Well, you got 10 months, I would hope so. Can we get one by summertime? Can I get you to go out for a little bit more?
Quarter one, but definitely it's the first half.
All right, good. I'm glad you didn't say the millennia, you know, this millennia. But DR, most people feel like most people are sort of sanguine. Most experts are a little sanguine about this. Listen, we've all been through it before. We don't want to sound, you know, you don't want to dismiss the worries of folks who maybe haven't been through this before. But what happens if it does keep going down? When do you start to change your mind if this doesn't stop?
Well, that's a great point, and we're at a real good inflection point right now. You know, Charles, we have hit the lows that we hit on Tuesday, and then just a little bit below this are the overnight lows between Monday and Tuesday. So this is a very important point for us to look at. Going down below here, you know, we're still a long way away from many of our, you know, technical analytics that we look at, moving averages and such. So, you know, we have the correction now. If we tack on another 3 to 5% below this, then I think
let me ask you about the moving averages then, DR. I like to use the 50 and 200-day exponential moving averages, but they're so far apart. We've broken through these 50-day moving averages. Is it conceivable we have to test 200-day moving averages? Because that would mean a lot more pain, wouldn't it?
That would be a bunch more pain, Charles. I agree with you, and I can't see us getting down to if we got down to the 200 here, something else is going to have to break other than the sort of investor fear, the really overboughtness that we've had going on in this little volatility crash. Something else will have to come in and change this. Everything else is looking too good on the macro side.
John, what are you guys telling your clients?
Sure. I think the number one issue I think people are dealing with is that we are seeing a sea change from a dovish Fed to a hawkish Fed, presumably.
When did it become hawkish? When did Jay Powell become a hawk? I'm confused.
Sure. Just for the fact that he needs to now address inflation. And that's where everybody's saying, okay, yes, you're right. He is more dovish in general, but the Fed is going to have to start probably fighting some more inflationary pressures. I think that's the big question. Now, the QE is done. Quantitative easing is no longer kind of happening around the globe. That is what's going to happen. I think that's the biggest change we're seeing in the market today.
All right. Thank you all very, very much. Coming up this